Hello, everyone. Normally, in this talk, I we talk about the monthly outlook and what has happened in the recent month. But this time, I thought we'll just peer out and look at what's happening globally in the world in different markets, different asset classes, and then see whether how it impacts India and whether there is any benefit or implication on India. The first, of course, you would have all heard about the Silicon Valley Bank and its collapse. And the main takeaway is that interest rates can also have risk, right? As interest rates go up, just normal investment in bond markets can also have a pretty significant interest rate risk. India has seen that in between 2005, 2008, and in 2012, 13, where bond funds, just by investing in government bonds, also had poor returns or negative NAVs. And also shows another thing that the developed world, the interest rates have been so low for so long, almost 15 years, that as it goes back to its pre 2007 average, there will be significant impacts, implications, not only on households as they face higher interest rates, but on financial firms and corporates and governments, and even on central banks. Central banks today own a significant number of bonds, which they've bought at lower interest rates, and they also have the same problem of mark-to-market interest rates and interest rate risk. So it is a significant thing. It's not only restricted to one Silicon Valley bank or a few regional banks, uh, but it could be a system-wide thing, and which is why the Fed very quickly reacted to it by giving a liquidity window to those stressed banks if they need capital to pay off depositors. What we learned from the Silicon Valley Bank thing is also that startups had invested, and not only global startups, but we had some Indian startups. We saw some reports of they having certain amount of their cash balance or banking with Silicon Valley Bank, or getting money from Silicon Valley Bank as a startup in terms of loans. And Pankaj Pathak, the fixed income fund manager at Quantum AMC, had a very cheeky take on these Bengaluru startups that instead of parking your surplus cash with the Silicon Valley Bank, they should have actually parked that money with Quantum Liquid Fund, because with a very simple logic that even when you choose a bank or a money market mutual fund or a liquid fund, you have to ensure that the liquid fund does not take too much market risks. It does not take too much credit risk. It has liquid securities in your portfolio because that is the main mandate. And it also runs risk management stress test in terms of what is the share of depositors who can, or investors who can redeem on one single day, and do I have enough protection, do I have enough liquid securities to be able to do that. So Quantum Liquid Fund, obviously people who know us, have been following us, has been doing that for many years, and will continue to do that in terms of prioritizing safety and liquidity over returns for your surplus cash investments. The other issue, of course, has still remained the issue on Adani group of companies, right? We recently learned about a group called GQG Capital, which has invested into the firm and taken off some shareholding from the family, and they gave a statement that the group assets are fantastic and irreplaceable. Uh, if you look at the way we've managed money and the flagship, what we call the value with values portfolio, we had a very simple approach to investing, which is shake hands and get your five fingers back. If you do not get your five fingers back, do not invest in those certain groups, certain management, certain businesses, certain sectors. So irrespective of how fantastic or irreplaceable those assets are, if they do not meet our integrity screen, as we call it, in terms of the management and the corporate governance and related party transactions, the quantum value equity fund will not invest in certain groups and certain businesses. That's another takeaway for you. uh, i I also wanted to talk about, these are all issues, crisis that comes about in the market, right? And uh, we've seen over the very long period of time that India has faced these crises, but has always almost come out and stood out. It has had the resilience. And it was Raghuram Rajan, the ex-governor of Reserve Bank of India, when he took over as governor, and in his maiden speech, he mentioned that uh, India and crisis, these two terms should never be used in a sentence. And he's right. I mean, and as I'll talk to you about it, uh, the 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 Indian story is a micro story. It's a micro story of individuals, businesses doing what they do. It is also a story of, in every crisis, we've seen that the government and the regulators and the policymakers, they make changes, they do reform. There are so many low hanging reforms that are available, that they're able to look at a crisis and reform and put in place certain practices, certain rule of law, certain regulations, or certain opening of the markets, which ensures that we do not repeat the same mistakes. And generally, we've seen over the last 30-40 years is that regulations have gotten better and more entities, institutions, businesses have to maintain a particular level of governance to be able to operate and sustain in this business. So India has always seen that. And if I just look at the regulatory aspects, uh, and if I go back, India faced a lot of, say, financial scams, right? Stock market scam, Harshad Mehta in 1992, Ketan Parekh in 2000. Then even mutual funds saw its own period. We had the Chain Group Bhansali scam in 1996, the UTI blew up in 2003, and then just the entire mis-selling and of mutual funds, the cost of it. And we've seen how SEBI has responded to it. They've built a reasonably robust trading and stock market infrastructure system to ensure that we do not have repeats of those scams, and RBI has also helped in that. And if you look at the mutual funds, the way the regulations have lowered the cost, cleaned up the system, make sure that mutual funds, have a investment philosophy and have a governance structure that is that is easy for retail investors to invest. And we've seen the impact of that. We've seen retail investors coming back into the market in a big manner. If I look at RBI also, uh, the fact that RBI had to pledge its gold in 1991 to secure some funding to meet the balance of payment crisis, ensured that when the Asian financial crisis happened in 1998, or the global financial crisis post the Lehman Brothers collapse in 2008, India got impacted, but not as much. There were regulations put in place for banking and the external sector. We saw India being part of Fragile Five in 2013, and we almost saw that the RBI had kind of lost control on the rupee. But reforms post that, monetary policy, liquidity, external sector, has ensured that India is no longer part of Fragile Five in terms of if you look at the external sector and the rupee. They've also dealt with a fairly bad asset quality problem. So the asset quality review and the recapitalization, and then the crisis of ILFS, when ILFS collapsed, and then COVID, you've seen a significant impact on the Indian banking and financial firms. It also accounted for a few banks, a few NBFCs, and even a few mutual funds who had to shut down. But generally, the regulations have kept in pace, and the regulators have acted, the government and policymakers have acted to ensure that it hasn't become a contagion. And these are things that people should always think about, that there is always risk, and there's always frailties, and there's always some kind of crisis. But India has these mechanisms of either a regulatory or just its own micro and macro opportunity that it takes about. So India is very chaotic. It's a democracy which has its own pulls and pressures. Corruption is still a reasonable part of India's governance structure. And generally, you will see that people are a bit pessimistic, but the chaos is what creates the opportunity. The democracy is what creates checks and balances, and ensure that India is not a China or not a Russia or not a Turkey in terms of the governance and politics. The corruption is an opportunity for cleanup. And India will continue to disappoint both the pessimists and the optimists. But if you just look at from a long-term opportunity perspective, considering the risks, the fact that the Indian GDP growth in real terms has grown at about 6% plus, about 6.2% in the last 40 years, is a testament to this fact that India has faced all kinds of crises and opportunities in the last 30, 40 years and still developed and grown at that 6%. It has not grown at 9%, but has not collapsed like many other emerging market economies do. And if I look from a market opportunity perspective, if I look at long-term equity returns, the Indian equity markets has grown almost 2x of the US and even more if I compare it to emerging markets or China, much to the dismay of many global investors who have remained underallocated to Indian equities, right? So you have to consider that India has its frailties, India will have its issues. But if you have a sensible risk-adjusted investment framework in your mind and your expectations are muted and realistic, India does its own thing and will deliver that opportunity and that return to you. So this is my takeaway for this month. So we've put out a piece on this on the Quantum Advisors website. So if you want to have a look at it, it's far more detailed and with a lot more charts and graphs explaining what I just said. So thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.